Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, the actor strike seems to be over, so you won't be missing any more episodes of Keeping Up with the Kardashians. I'm not even sure if that's still on. The IRS, due to inflation, will be having a new tax bracket and will reveal just how much you're going to be paying. So why are these stock traders so happy? Well, it's because the S&P 500 just had its best 9-day rally in 2 years. So is this the start of an early Christmas rally or maybe a head fake? Tonight, we're going to be talking with the chief market strategist for Crossmark Global, Victoria Fernandez. After 3 months of down returns, the stock market has soared from November the 1st. We're going to find out if there's more good times to come with Victoria Fernandez, all coming up. We're here, you're there, and for the next 28 minutes, this is Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. I'm Andre Laborde. It's Friday, November the 10th. Well, a big show ahead, so we're glad you're here. It was a big week for your money. Since November the 1st, the Dow Jones broke its 7-day winning streak, ending Tuesday, but it continued today, only interrupted by Wednesday and Thursday. And the S&P 500 this week hit its 8th positive day, and the Nasdaq did one even better, posting its 9th winning day in a row, all ending yesterday. Well, this week, the Dow Jones closed today up 0.6 of a point for the week. And the S&P 500, they closed today up 1.3% for the week. And the Nasdaq, they closed today just under 2.4% for the week. Since November the 1st, technology is now up 9.5%. Discretionary stocks are up almost 8.5%, as well as communication services and financials. And the VIX, which measures the Wall Street volatility or fear gauge, it registered its 8th straight day drop. And that 8th straight drop is the longest streak of a daily decline in 8 years. Now that's saying that despite everything that's going on, fear on Wall Street is dropping. So if you feel like you've missed something here, don't. We've all known someone, or maybe even ourselves, who've tried to time the markets. At the beginning of 2023, we had CNBC reporter Bob Pisani on our show, and we talked about not trying to time the markets. If you missed that show, well, don't ever do that again. Or you can always catch us on our shows on YouTube, just as a reminder. But right now, the S&P 500 is up about 14% since January the 1st. But despite those gains, there have only been 11 more up days than down days for the S&P. The only 2 days when the S&P 500 popped over 2% was back on January the 6th and on April the 27th. And if you would have missed just those 2 days, your returns would have been a lot less. So if you would have invested $10,000 in the S&P 500 in 1970 and never touched it, according to Dimensional Advisors, today that would be worth $138,900. If you would have missed the best performing day, just one day, you would have just under $124,500. And you missed the best 5 days, it would have dropped to just over $90,000. Best 15 days, just over $52,000. And if you would have tried to time the markets and failed and missed just the best 25 days in 52 years, that $10,000 would be just under $33,000. Now, there are about 250 trading days in any given year, and over 52 years, that's about 13,000 trading days. And here's another way to look at it. If you would have missed just those 25 days out of the 13,000 days, your market return would have been 73% less than if you would have left it in and done nothing. So, with only 38 trading days left in the year, will there be a Santa Claus rally? It's 2 weeks from today, by the way, for Black Friday and the start of the holiday season. And according to a Morning Consult poll revealing that 39% of high-income earners are considering using the buy now, pay later loans. So will this consumers be buying as much this year as in the past for holiday seasons? How will the stock market surge since November the 1st affect the remainder of the year and going into next year of 2024? Is a recession still on the menu? Tonight, happy to have back the Chief Market Strategist at Crossmark Global, Victoria Fernandez. Hi, Victoria. Welcome back to Wall Street Wrap-Up.
Thanks so much. It's a pleasure to be back.
Since November the 1st, just middle of last week when the Federal Reserve decided to pause with their interest rates again, the markets have been going great as compared to August and September and October. Do you think that this is the start of maybe a rally for all the way to the end of the year, or do you think this is just like a bubble?
So, Andre, it's a really good question because historically, November and December are the best combination of 2 months for the entire year. And it makes a lot of sense, right? We are a consumer-led economy. We're going into a holiday season. I always like to say the U.S. consumer likes to spend when they're happy, and they spend even more when they're sad. So regardless of kind of how they're feeling right now, we should have good consumer sentiment moving into the rest of this year, which means we should probably see that Santa Claus rally that we typically see. Now, that doesn't mean we won't have volatility. I do think we are not going to see just kind of what they call a straight up and to the right equity market. I think there's going to be some pullbacks here and there in the markets, and we have to be prepared for that. But we will probably end the year a little bit higher than where we are. I actually think it's the first quarter of next year where we might start to see more of the issues come to the surface.
Last week, we had the Bureau of Labor Statistics having their October jobs report, and they were expecting 180,000 jobs, and they only got 150,000. Next week, we've got consumer CPI and PPI going to be being released. But one of the things I noticed in last week with the jobs was that of the 150,000 jobs, about 1/3 of them were government jobs. Well, as we all know, with government jobs, you don't have to make a payroll, and you're not producing something. And so I'm curious: is the economy as strong as it may be appearing?
I definitely think we're starting to see cracks in this economy, and it makes sense, right? How long ago have we been looking at the Fed raising rates, this 525 basis points of rates that need to work its way through the economy? And we've heard that phrase, long and variable lags, that it takes a while for rate hikes to really affect the consumer, to affect corporations, to affect the labor market. I think we're just now starting to see the elements of that work its way through the economy. So we could have a little bit of a weakening here. Now, if you had asked me 6 weeks ago, I would have told you I actually thought we might go into a recession before the end of this year, a very mild recession, but because we were concerned about earnings, we were concerned about margins for corporations, concerned about increasing layoffs, and that the Federal Reserve maybe wasn't done hiking rates and they were going to continue to push rates higher, which was going to affect the housing market. So I think that the economy is starting to show weakness. We'll probably see some more of that. But because we are in such a strong seasonal period of the year, that might be mitigated a little bit by spending. The other thing, Andre, that I think people need to pay attention to, remember, next year is an election year, and an administration never wants a recession in the year of an election because they don't win. So I wouldn't be surprised to see the administration put some more stimulus into the economy just to make sure that things go well.
More stimulus maybe in the economy, would that then possibly increase inflation because of all the different amounts of stimulus that we had prior to this?
That's exactly right. And it's the inflation that the Federal Reserve is battling so desperately. We are still almost double the target rate for inflation. So I know there has been disinflation, right, where prices are rising at a slower pace than they were before. But we haven't had deflation, where prices are actually coming down. And I think that's what the consumer is waiting for. The longer that we stay at these elevated levels of inflation, the easier it is for that to become more ingrained in the economy. And you add on top of that government stimulus, and you are absolutely correct. It could push inflation higher. And if inflation goes higher, what is the Federal Reserve going to do? They're going to have to go right back to their playbook of hiking rates, which is why I think we have to be very cautious going into next year.
With the holidays coming up, and as you say, when consumers spend when they're happy and consumers also spend when they're sad, but at the same time, they also don't spend if they feel like they're about to lose their job. Right now, we're like at about, 3.9% unemployment.
Correct.
So if you think that, do you think consumers are comfortable in keeping their job, which means that they're going to be spending, or do you think that they're going to be nervous about losing their job, in which case they're going to hold back this holiday season?
So one of the data points that helps us get a good feel for that comes in what we call the JOLTS report. And it tells us, how many people are quitting their jobs, how many are transferring to other jobs. Over the past year to 18 months, we had people quitting their jobs, moving to new jobs, and doing that because they were getting pay increases of anywhere from like 7 to 20%. So it made sense for them to do that. Watching the rate at which people are quitting is a really good signal for the labor market. And we're starting to see that slow down a little bit. They're not leaving their jobs as much. They're not seeing greater opportunities and higher wages in other jobs. To us, that means people are going to start to be a little more conservative. Maybe they start to save a little bit more. Now, savings rate is down from the pre-pandemic area, but a lot of that is because people feel like their net worth is higher, so they're saving less. So you're absolutely right. We have to watch that labor market, and it could start to tell us the consumer is going to start saving a little bit more, or just be a little more cautious on how much they spend.
I saw a report this week, Victoria, where temporary holiday employees and basically retail stores, they're hiring less this year than last year, and they hired less last year than they did the year before, which was the year before the pandemic. So with that, is that sort of like what you're talking about, where maybe employers are pulling back, which might make a concern for the consumer?
Absolutely. It's another signal that we have to watch. You see it in retail stores. Look at like the warehouses, right? How much are they hiring for the holiday season? I actually saw a report this week that Federal Express said it looks like they're not going to have enough shipments to fulfill all of the flights they can do with their pilots that are currently on staff for the holiday season. So that tells you that even the delivery services are saying, wait a minute, we're not anticipating as much business as we have had in previous years. So these are all signals that perhaps the consumer starts to pull back. But I'll tell you, Andre, I say don't ever underestimate the consumer, especially when it comes to holiday times. People are more willing to put purchases on credit cards. So we have to look at revolving debt and see how that's going to come along as well. That's going to be something we're going to be watching really closely to see what kind of situation household balance sheets are in at the end of the year.
Well, Victoria, we still have one more meeting with the Federal Reserve coming up in mid-December. So if we've had like two pauses so far, do you think that they have finished raising rates for right now? Or do you think that they may want to not look dovish and just to throw another 25 basis points in? What are your thoughts?
So it's a tricky question in the sense that a lot of it, I think, is going to rely on what the inflation reports are that we get for the rest of this month. We get the CPI inflation report around the middle of the month. It's the 14th or the 15th. We get the PCE, which is the Federal Reserve's favorite inflation guide, coming in on November 30th. So those two elements, I think, will play a key role in some of the decision making that goes on at the next FOMC meeting. If I was a betting girl, I would say they're probably going to pause here at the end of the year, finish out the year without any surprises, because the market is not expecting another rate hike at this point in time. They typically don't pull a big surprise. So I think if they're going to hike in December, we're going to hear a lot more hawkish speak coming out of all the Federal Reserve presidents between now and that point in time.
Well, Victoria, when do you think, okay, since we might probably have a pause for December, let me go the opposite way. When do you think they may have a cut?
Yeah, I felt like I was on an island for a really long time when it came to this topic. Our CIO, Bob Dahl, and I kept saying, when everyone would say there's going to be rate cuts in 2023, this was back at the beginning of the year, probably closer to the time you and I spoke last. And we kept saying, there's no way. We're not even going to be at the inflation target by that point in time. There's no way they're going to cut rates. And we saw that start to get priced out of the market. Now, after the last Federal Reserve meeting, we did see, if you look at the futures market, there's some bets that they're going to start cutting around the middle of next year. Again, I think that's too soon. The Fed has worked too hard and too long to try to get inflation down just to turn around in a few short months and start cutting rates, which means demand would increase and that would increase inflation again. So I'm looking more towards the end of next year before we see any rate cuts, even though I know that goes against what the futures market is telling us.
Okay, so by the end of next year, do you think that there's still a possible chance for a recession to be coming, maybe not at the end of this year, because we've just got basically 5 weeks or so, but anything in 2024?
Yeah, I would be surprised if we didn't see a recession in 2024. Now, I don't think it's going to be a huge recession. I think it'll be mild because we do have some supportive elements. I mean, let's look at the GDP report that came out, right, for last quarter. I mean, that was a really strong report. There was strong growth. I don't think we're going to have that in the fourth quarter of this year. I don't think we're going to have it next year. And earnings expectations are actually coming down for the fourth quarter. This is the first time we've seen this happen in quite a while. So it's telling us that the sentiment is starting to come back a little bit, slow down a little bit from where we are. And there's a lot of elements that we are seeing that are typical flags for a recession. Look at leading economic indicators, things we're seeing with the yield curve. There's lots of things that are kind of flashing yellow here for us. So I would not be surprised to see a mild recession, probably in the first half of next year, even though that's later than what we originally thought. Then that gives the Federal Reserve a little bit of time. Inflation will come down, unemployment will go up a little bit. They'll probably reach their targets, and then they can start cutting in the second half of the year.
Well, Victoria, how would you advise, say, like your clients, if we're possibly might be having a recession, maybe a soft one, maybe next year? Would you advise possibly going into bonds like Treasury bonds, the Russell 2000, which are small caps, or do you prefer large caps or just cash? What would you do?
So I don't want to say all of the above, but really and truly, you do want to have a little bit of all of these different elements when we're in the type of environment that we're in. Look, we don't like to go to our clients and say, guess what? We think a recession's coming, but we do want to go and say, there's a lot of volatility. We think there could be a mild recession. Obviously, we don't know for sure, but we think there could be. So we want to position appropriately. We want to have some defensive components to our portfolio. Healthcare is a sector that we like to have in our portfolio right now. It's been knocked down quite a bit this year, so there's some good entry points there. As you have a yield curve that starts to steepen again, financials are a good place to go into. Once you hit that recession, that's when you want to start adding in your portfolio some of the risk on elements. So you're saying about small cap, they will take a big hit, and then you can go in and pick up some of those names. But have some equities, have some fixed income. You can get 5% and lock that in on the short end of the curve. You can also, if you're a longer term investor, go out a little further in your bond portfolio, 5, 7, 10 years, lock in some cash flow at these higher rates, because we do think rates are going to come down over the next 12 months. So you can lock some of that in. And don't forget, you always need a little bit of powder there in case the market turns and you want to make a move. So we would have a little allocation to cash as well. And that should keep you well prepared for whatever we see happen in the market.
For the last couple of weeks, we've seen you talk about Treasury bonds, and we're talking about whether the 2-year and also more, the 5-year, the 10-year, they were hitting like 5%. Now those yields are going down. Does that mean that more people are buying the bonds, which means that the yields are going down? Or does it also mean about the Treasury Department is maybe selling fewer of them? What are your thoughts?
There's a combination of things that really made yields come back from those high levels. So you're right, the Treasury came out and announced what their refunding was going to look like, how many Treasury bills they're going to issue, how many 2 years, how many 3 years, such forth. So what happened is it was less coupon issuance than what the market thought and more Treasury bill issuance. There has been such a concern over the interest cost of our country going forward. It has surpassed 14% of the revenue. And that usually is a point in time where the government really goes into austerity mode. And obviously, we're not. We're actually spending more in Washington right now. So there was concern over how many coupons they were going to be issuing, and that was less than expected. So yields came down a little bit. Powell was a little bit more dovish, a little bit more conservative in the things that he said at the Federal Reserve meeting. That caused yields to come down a little bit. And you mentioned earlier the payrolls report, right? It was weaker than expected. That made the market believe, okay, maybe the Federal Reserve's not going to hike rates again. So yields came down a little bit from that as well. We have auctions this week, and so far those have been strong auctions. So that made yields come down because more people were in there buying. So all of those elements combine to bring yields down, prices up on your fixed income securities.
What about, you were talking just a little while ago about different type of sectors. Well, if let's say the Federal Reserve may not be hiking anymore and may toward the end of the year be actually cutting, would interest-sensitive stocks, and I'm thinking of technology or REITs, would those be certain sectors to get in beforehand now, before they start cutting?
I think you can start dipping your toe in the water, right? Think of it as really, really cold water. You just want to do a little bit at a time because the market can turn on you pretty quickly. We've seen that over the last couple of weeks. You know, we had some really down days, and then the market's been really up, as you mentioned, over the last week and a half or so. So I think you can find some elements. I also want to caution that you don't go just all in on a sector right now. Really pay attention to the individual names that you're buying. In this type of environment, you're looking for companies that have really strong balance sheets. You want them to have good cash positions, strong cash flow. You want them to have good return on equity. These are the types of companies that will perform well in volatility. So yes, you could start dipping your toe in some elements of the market that do better when yields come down. But again, take baby steps. When it comes to REITs, I might wait a little bit longer. We're starting to hear more and more about office vacancies and what that's going to mean for some of the regional banks. So I might wait a little bit on REITs, but some of those other rate sensitive sectors, I think you could start looking at.
Well, you mentioned just a little while ago about, with earnings and such. I think we've got about, and correct me if I'm wrong, about 85% from third quarter. But their future guidance, which normally the CEO gives for how we're going to be doing in the fourth quarter, is somewhat a little bit of a downer. Did you find that, or how would you prepare yourself in your portfolio or your client's portfolio if those earnings are not as good in the fourth quarter?
Yeah, it's interesting you bring up that actual topic. I was reading a statistic where of all the S&P companies that actually gave fourth quarter guidance, only 14% of those companies increased their guidance for the fourth quarter. Over 50% of those companies actually lowered their guidance for the fourth quarter. So it does tell us that companies are having concerns. Typically about 12 to 18 months after the Fed starts hiking rates, corporations start to feel it. And then it takes a little bit of time after that before they start making changes to help support their margins. And maybe that's layoffs, maybe that's raising prices, different elements. I think we have to be concerned about margins going into the fourth quarter. So again, it comes back to quality companies. If margins are going to be compressed, if we're concerned about the companies being able to put out strong profits, we want the companies that have strong balance sheets, that have strong cash positions, good interest coverage ratios. These are the things you have to look for. It's not a particular sector per se. It's more the companies within the sector that you need to be paying attention to. But obviously, if we're going to go into a recession, there's certain sectors that do better. You want to avoid some of those really heavy cyclical names.
Victoria, that's a great way to end it for this one, but I sure hope you come back because I always enjoy talking to you.
It is my pleasure. Thanks for having me. Look forward to talking again soon.
Thanks, Victoria. Hey, if you've got a question, maybe a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us at andre@benacapital.com. So now for a look at wrap up on Wall Street. Well, credit card debt is hitting new highs. According to the Federal Reserve of New York, Americans owe $1.8 trillion in just the third quarter of the year alone. Credit card balances have spiked by more than $150 billion year over year, and that's the biggest spike since 1999. And according to TransUnion, heading into the Christmas season, Americans are sitting on an average of credit card debt of $6,000 per year. That's up 15% from last year. And due to inflation, the IRS, the Internal Revenue Service, is creating a new tax brackets for the 2024 tax year. Those individuals in the top tax rate will now apply to those making just over $609,000. And married couples in 2024 will have their threshold filing jointly raised to those making over $731,000 per year, all because of inflation. Well, the standard deduction will also increase for the 2024 tax year to now $14,600 for individuals, and married couples filing jointly will be raised to $29,200 per year. Now, remember, this is for the 2024 year, so on April the 15th of 2025, this is what will be taken into account. So next Friday, on the 17th, is the date for Congress to either come up with a full budget or kick the can down the road one more time with a continuing resolution. Earnings for Home Depot and Walmart are going to be coming out, as well as the CPI, the CPI or inflation numbers on Wednesday for October. And Black Friday is just 2 weeks away. And for the stock market since November the 1st, well, that's been on a tear. We're going to be discussing these areas, plus your money, when our guest is going to be Scott Wren. Scott is the senior global market strategist at Wells Fargo Investments with over $600 billion of assets under management. That's Scott Wren next week. And that's a wrap-up for our show for this Friday, November the 10th. Our thanks to Victoria Fernandez for being with us tonight, but as always, we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love, and a happy Veterans Day tomorrow to all the veterans out there. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and also remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.